If one of these big risks materialises, economic growth slows down, those tech valuations are no longer justified, you could have super funds wearing big losses.
Let's start with the good news. The Reserve Bank says Australian households are facing less financial pressure compared to before.
That's right. A couple of years ago, when interest rates were at their peak, the Reserve Bank estimated that roughly 5% of mortgage borrowers were spending more than they were earning. They're in, negative cash flow. That estimate now is down just above 2%. And the Reserve Bank says that's because of a combination of rising real wages as inflation has eased and pay rises have picked up. It's also because of the stage 3 tax cuts that came through last year that are feeding through to more take-home income. And of course, the rate reductions, of which we've had 3 this year, that have already boosted the amount of money that those borrowing households keep after they've made their mortgage repayments. So they're quite comfortable with where households and Australian businesses generally are positioned.
But while that is the case, the Reserve Bank seems to also be worried about developments overseas. So what would you say is its biggest worry?
Look, the biggest worry is definitely the unpredictability around geopolitics and also economic and trade policy. So, of course, the US tariff policy of the Trump administration. Even though Donald Trump wasn't singled out by name, it is clearly a lot of the policies that are coming from the White House that are causing great concern. A good example was earlier in the year when we had the Liberation Day tariffs in April. The Reserve Bank, in its financial stability review, was saying had Donald Trump not backed down so quickly on those tariffs, we could have seen real financial market stresses and parts of the financial market actually cracking under that pressure. It was only the quick pause to the tariff implementation that actually kept financial markets relatively stable. And of course, we've seen the recovery since then, but the Reserve Bank says the risks haven't gone away. In fact, it says the risks in the global financial system are rising because we still have uncertainty about tariffs. And of course, we still don't know what the final tariff position between the US and the other biggest economy in the world, China, will end up being.
The RBA is also concerned about what's happening in the Chinese economy and how that might have flow-on impacts here.
Yes, so even before we see how big the tariffs the US ends up permanently imposing on China are and how that trading relationship develops, the Chinese economy still has its own internal problems, too much debt, too much previous investment in housing. China at the moment is actually undergoing a housing crash that's bigger than Japan's was in the early 1990s at the same point in time. So the falls have been steeper than Japan's big crash, which led to what was called the lost decade, but ended up really being a lost 3 decades for the Japanese economy.
So all up, Michael, with the risks from China, the US, worldwide, how might that threaten Australia's financial stability?
Well, obviously the risks with the Chinese economy are quite direct because they are our largest trading partner. Commodity prices could plunge if the Chinese economy slows down even further. There's also the superannuation sector, and that's a key player emphasised by the Reserve Bank in the Financial Stability Review. With over $4.3 trillion now in Australian super, it's simply too much money to invest locally. So our super funds have increasingly been investing offshore, particularly in the US, and there is huge concentration in the big tech stocks in the US, which are again priced for perfection. If one of these big risks materialises, economic growth slows down, those tech valuations are no longer justified, you could have super funds wearing big losses, you could have super investors trying to change out of more aggressive strategies into more conservative cash-based investments, and then you might see super funds having to liquidate a lot of assets into a falling market, and with that much money on the table, that could accentuate the falls in those asset markets, and that's the kind of risk the Reserve Bank's concerned about. The good thing is it is watching these risks and it's working with other regulators to try and minimise them.
Michael, thank you very much for breaking it down for us.
Thanks, David.